Good morning, good afternoon, traders, wherever you're from. Welcome to F.A.C.E. Here we are, Thursday, the 8th of January. The week is flying by already. Hope you're doing well. We've got Stelios in today. Morning, Stel. Afternoon, Stel.
Hello, everybody. How are you doing, Ryan?
All good, mate. Thank you very much.
I shouldn't be asking about West Ham, though, should I?
Right, I'm off.
Yeah, they're going to bounce back.
Yeah, maybe next season after we get relegated. Oh, see, now you got me started. No, you had to put me in a bad mood.
Sorry about that.
Yeah, I've been avoiding that conversation all week. Oh, thanks, mate. Right, no, good to have you on board, as always. Hey, Kay, how you going?
Oh, I couldn't find my unmute button. Yeah, good morning, Ryan, and afternoon. Afternoon, Ryan, afternoon, Stelios, and good morning, afternoon, everybody. We're doing fine.
Yeah, we're doing fine. Soon be Christmas. That's one thing we know about the way this week's going. Anyway, but you can continue your Christmas presents if you like, because we have a sale on the trader funding program. 30% off all our accounts, whether that's instant funding or assessment accounts. Use code New Year 26 when you sign up. I'll put the link in the Zoom chat for everybody. That's going to until January the 18th. So a few days left on that next week. It'll be gone. Right, let's get cracking about what's going on. One interesting thing I want to start with, we've had, I think we're going to have to call it Trump trading once again. So you Yanks probably caught this in the latter part of your day yesterday. He's taken it to the housing market, apparently telling investment firms, some of the big investment firms, asset managers, that they will be excluded from buying single family home sales. We had a bit of a discussion about this on the Flow show earlier, what that might mean for the housing market, for prices, and thus the ramifications for the Fed. But something else he did as well, he's also taken it to the defence sector. He's not happy with the speed at which defensive firms are producing arms, whatever, missiles, anything to do with defence, aircraft and the likes. So he's apparently going to ban share buybacks, ban dividend payments, and restrict the amount of pay that executives can take. Now, I caught one of those headlines last night, and as you can see, this is what happened in some of the big defence stocks like Lockheed. We saw a big sell-off, and then in typical Trump fashion, he turned it around by saying, oh, we're going to do that to the defence sector, but I want to increase defence spending by 500 billion to 1.5 trillion by 2027. And that's why we got a pre-market rally.
Since there is so much room in the balance, right? I mean, with all these surpluses, we can afford spending a little bit more in defense.
Tariffs, mate. It's all going to come from tariffs, isn't it?
Of course.
But
sure.
No doubt someone had this news beforehand, and then someone had the defence increase spending afterhand. So is your typical Trump trade as usual. Excuse me, I've got my squawk on again. So that's going to be interesting for these sectors moving forward. The defence sector, also the housing sector, different ramifications that we probably need to look at over the foreseeable future. Kay, what did you make of all that news overnight? A bit of volatility in those sectors, obviously. The usual Trump stuff, though, threaten, and then try and get a deal done.
Yeah, absolutely. We were, as you say, talking about it on the Flow show. It's those defense stocks, yeah, they got a bit of hammering. Also, the holders of a lot of those houses like BlackRock, etc., just to name that one, they also got a little bit of a knock on the head. It's probably going to take a bit of time to put that in place. And as I was saying, I don't think that those how shall I say, asset managers who own a lot of those houses will sell off their stocks straight away. But there may be some coming onto the market, which is only going to be better for the U.S. public. Against that, if we get an adverse ruling tomorrow, it's maybe not going to help a lot because yields are going to rise. But Yeah, I think it's anyway a good thing. I guess the housing market can cool down a little bit because we know a lot of those managers, money managers, have been scooping up all those houses. So maybe a little bit of a cooling down there, which is should be good for the US consumer in a way.
Yeah, absolutely. And obviously the ramifications for the Fed that if those guys aren't buying up properties, then prices might come down. And as we know, housing, rent, shelter pricing has been one of the big sticky points in inflation. If that begins to ease, that might put the Fed on a more dovish footing. It's all conjecture at the moment. Obviously, it needs to play out in time. But as traders, we like to keep an eye on the things that might happen in the future. Then we know how to react if they do happen. I don't know if any of that has been behind this sort of general easing in stock markets. I mean, we're only talking small beans at the moment. We did have that poke above the all-time highs to fresh all-time highs yesterday, and then you had obviously this bit of coming off late in the evening when we got that news about the defence stuff. So maybe stocks might be a little bit on the back foot today. We'll see when we get the cash open later on as to whether the BTFDers are back in. We'll have to see. Just some other news I want to make, particularly US guys, aware of. Just something that's been bubbling on. I don't know how much you're reading or seeing about this over in the US, but there's been a lot of Iran protests going on. The population very not happy with what's going on over there, the situation. Obviously, they're getting a squeeze put on with sanctions. It's causing price issues and all sorts of stuff going on over there. Not a good situation. And there have been growing protests around the country. This sort of thing has happened before. It has often been quashed pretty quickly. But this one might have the potential to grow into something bigger, potentially leading to a regime change, which is going to have huge ramifications, not just for Iran, but for the whole of the Middle East and elsewhere. So just something, again, to keep your eye on in case we get something happening over there. Oil markets, everything really, risk in general. Right, what else is going on? Price-wise, not an awful lot going on. Euro's really stuck in the mire at the moment. We're stuck between sort of 117 and 116.60, bit of a wider range up to sort of 117 and a half. We are keeping in this downtrend, though, that we've had since the latter part of the year coming into this year. So the dollar is still, looking a bit better in the early part of this year. How long that lasts is anyone's guess. Again, discussing this earlier with K-Man. Could be in for some pendulum swings. Dollar looks okay now, get a bit of bad data, and suddenly the dollar won't look so good until the next bit of data, and then it swings the other way. Kay, your thoughts on the dollar generally at the moment?
Tomorrow, I think tomorrow we should be seeing a bit of moves in the dollar on the combination of the NFPs and whatever SCOTUS may come up with. Expectations are what they are, but still there should be a little bit of dollar moves there. That being said, vols are still suppressed, so maybe the better instruments will be to be found outside of euro dollar that you're looking at there, because that's a very, very slow one for the time being. Yeah, dollar is doing relatively okay, but it's extremely slow, and so hopefully tomorrow we unlock the situation for some dollar trading.
Yeah, absolutely. Stel, have you come with your charts today?
I have indeed.
You
I have indeed.
give us your view on the buck and yields, perhaps, and anything else you want.
Yes, sir. So let me take the screen. Hold on. I'm going to echo what Gregor wrote actually was it on the chat room today or on Twitter? I can't remember. That the first week of trading is always dominated by flows, by start of year flows. So I wouldn't give too much, I don't want to say importance, but I wouldn't put too much weight on it. And especially given that it's a NFP week as well. I want to wait and see what happens next week, but obviously tomorrow's data is important. The only things that seem to be moving these days are metals and cryptos. Everything else is kind of staying in range. And I mean, looking at yields, we are right bang, smack bang in the middle of this admittedly tightening structure. And I still think we're going to be going lower in yields in both the US and the UK and then pretty much everywhere. I know I am probably the contrarian in this, but I think there's going to be more easing. There's going to be, central banks are going to be looking for any opportunity, or no, not opportunity, any excuse to be easing as much as they can. Bond buying, QE, whatever they want to call it. But at the moment, we are stuck in a range, and the 10-year UK actually yield is looking like it's broken down from this trend line. Quite a few touches here, and it broke down yesterday, and I think that's heading lower as well. But for now, the US yields are still going sideways, so nothing much to say on that. The dollar is also last few months for me, because I'm not a day trader, so I don't look at 10 or 20 pip moves. Overall, the dollar's been quite, moving sideways over the past few months. We are now smacking our head against the 50 and the 200 DMA. So that's going to be important. Theoretically, you want to see, or you should see, a reaction going lower from there. But so that means dollar weakness. But if that doesn't happen, then I think we're going to be looking at the start of a proper, like, bull leg higher for the dollar, but there's no sign of that just yet. And tomorrow obviously could be a big market mover either way, depending on which way the number comes. But again, yields and the dollar for me are doing nothing. Contrary to that, stocks are still looking pretty good. If you're close to or at all-time highs, you cannot say anything else. Nothing bearish about this in the way I look at it. Yes, RSI is kind of dropping, so a small divergence, but overall, nothing bearish about this. And remember, I did say in December, after the FOMC cut, I said I think we are looking at a quarter of risk on. Next quarter being risk on. So, and I remain of that conviction, and I don't see anything at the moment that's changing that. And especially if yields start moving lower, which I think they will, then this should be a tailwind for equities. So the S&P at all-time highs or close to, the DAX at all-time highs or close to. I mean, nothing bearish to say about this. So try to short these markets, as has been the case since COVID, really. Yeah, you're gonna get burned. So I would say people should be cautious shorting quiet markets and shorting markets at all-time highs. So so with that being out of the way, we have to look at metals, and gold has been, as always, the most steady, the most resilient one. Of course, the performance of silver last year has been quite a lot stronger than gold, so it's been catching up on the gold-silver ratio. There was this big trend, there was this trend line which was broken. As soon as that 78, we were talking about this on the chat room and here on Face. As soon as that got broken, I mean, just straight down. Really impressive, actually. And this was, remember, this was late November. So a month and a bit, and we've gone from 78 to just under 60. Very impressive move. But so going away with gold, gold's been very steady. Not much to say. Silver, though, has been very volatile. And if you look at the move from April of last year until the highs in end of last year, that was a move from 28 and change up to 84. I mean, that was incredible in less than a year, 9 months. So with that move being as quick and as brutal as it was, you have to expect pullbacks. And I wrote on the chat room this morning, as long as silver is above 70 or 70-ish, yeah, let's call it 70. This is just a sideways consolidation. I know it's a very, very wide daily range. Today's high was 80, I think, and you know, you have a $5 move in silver intraday. It's a massive move, but still, this is just sideways consolidation. RSI goes down from way, way overbought, you know, 87, whatever it was, back down to the 50s. So this is actually, if you're a bull in these metals, this is actually not a bad thing to see, because this means that the markets are resetting, and you know, the leverage longs are getting flushed out, because these moves have been very violent today and yesterday, and they started in Asian hours, which are more illiquid than US hours and European hours. And so you're seeing this move, you know, momentum resets a bit, you know, people get flushed out, and then you continue moving. I think as long as we're above 70, this is still trading bullish. If we go below 70, then things change, and I think there is a high chance we might visit the mid 50s again. But for now, this is how I look at it.
That will be a godsend opportunity for many people, Stelio.
It will be if we get there, but you know, technically, this is what I see, and it's a similar story for platinum. Again, very strong move, sideways, not sideways, but you know what I mean, consolidation. I got, for people who have been in the chat room, I got long platinum and palladium on the breakout of this. It was the 15th of December, so you know, I've got my stops basically just below 15 silver and the equivalent levels in platinum. It's still going to be quite nicely in the money. I mean, it would have been nice if they both continue higher and not break below, but if they do, I take my stop and I look to re-enter, because I think platinum and silver and palladium, if we do break lower, technically we're probably going to continue a bit more, and I think the market's going to give us a better level to get long. But for now, we're still going sideways. I mean, I've talked about this with the people on the chat room. This is the ETF that I bought on the 15th. So as soon as we broke above this high, I got long there, and you know, I'm waiting to see. This is platinum and palladium physical spot physical ETF, which I really like. Very liquid, low fees, and etc. So just for information, this is what I have. But anyway, to cut a long story short, I think metals are trying to consolidate sideways. I think we know where the technical levels are. If they get broken, then I step away and I reconsider. Oil is another interesting one. You know, people were talking about with Venezuela, the Venezuela story is going to be a lot more supply, etc. Well, that's not the case. I've been reading quite a bit about it. You know, the production facilities and the quality of oil in Venezuela is not like Saudi Arabia or the US or the other producers. So it's a bit more tricky. But in any case, oil technically still looks bearish, and you know, we're very close to these lows now at 55. If that gets taken out, well, I don't know where we stop. But remember, I've been talking about oil for months now, and I've been saying I do not want to be long oil at the moment. The only thing that would worry me, being short, is that from what I read, at least, there's a lot of speculators who are short, heavily short. So that increases the chance of a short squeeze if something happens, if some kind of an event happens and oil starts squeezing back above 60. The other thing that's moving is cryptos, and we have to say cryptos are underperforming in a big way, both metals and risk assets. And you know, forget about metals. Bitcoin had been correlated with the S&P quite well, or very well, for quite a few months, a couple of years actually, and now it's underperforming and it's going sideways in what looks like a bearish flag. And if that breaks, then you know, we're looking at, I don't know, 60,000, something like that. So doesn't look good. Yes, we are in the middle of this flag, so it's still consolidating sideways, but this is not bullish. So I would, you know, my bias changed. If you're a Forex Analytix subscriber, you will see in our platform, my bias changed. My macro bias on Bitcoin changed as we broke below 100 back here. And I said, right below this, I'm bearish, and it's still going, and it's it's consolidating in what looks like it's a bearish formation for me. And it's a similar story with Ethereum, again, going sideways, underperforming. It's a tough one. And you have one big whale, MicroStrategy, who is not doing well, and they're last I read, I think
Not
their average.
MicroStrategy, mate.
Oh, sorry, strategy,
Strategy.
yeah, mega strategy.
Mega strategy, yeah.
Their average long is what, 70,000 or 70 something thousand. So we're
In my
getting there.
mind, is unavoidable that the day will come that this company is going to implode in a spectacular manner. Because if your business plan is that you keep martingaling indefinitely, at some point, I mean, unless you believe that Bitcoin is going to keep rising to infinity, which so far humanity hasn't, had an experience like that ever.
It's
I
a
think
dangerous strategy, very dangerous.
I think that whenever we get some kind of a massive sell-off in risk assets, which eventually will come, right?
Yeah.
Eventually, there is going to be the moment of reckoning that like we had the last time we experienced it was in 2008, right? Pretty sure all cryptocurrencies, when that happens, are going to be cut by 60, 70% at least. And pretty sure that's going to be the moment that anybody that's following such a strategy is going to completely, implode.
Yeah, that's going to be a dangerous time, that's for sure. Anyway, crypto is looking not looking bullish at all. A couple of other FX pairs to look at. Euro pound is try to break out, didn't manage. I haven't had the position in Euro pound in quite a while. I'm still not touching it. The one that I would not go, overall, I think the dollar could, especially if it breaks above that 250 DMA, the Dixie, I think that it could have a nice leg higher. The one that I wouldn't get along of is still dollar mex, and I've been saying this for a while, and it has been creeping lower. Positive carry being short again. It's just the one that looks the strongest out of all the dollar pairs, and by strongest I mean the weaker dollar pair. So that's the one I wouldn't touch on the long side, and dollar Norway is the other one I wouldn't touch either. So if you want to be bearish a dollar, these are the two ones that I like to the downside. That's it. I don't know what else I have to say. Actually, that's pretty much it. Yeah. I don't know if anybody else has anything else to say. We've got about 7 minutes to the data. What kind of data do we have?
Jobless claims,
jobless data.
a bit of trade data as well. I was going to maybe Kay, you want to grab the screens because I had some bits to look at.
Sure, and it's been all over the news and on X now, so I might as well show it. It's not like that we only look at it on in our Forex Analytix community. You see this, right? There's the Beacon Index, and it officially the window starts tomorrow for, I think it's 5 sessions or so. We're going to have a rebalancing of this index, which happens once a year. And there are, well, the one that people really are looking at is cocoa, actually, which goes from 0% in the current weighting to 1.75% in the 2026 target weight, which apparently is equivalent to the whole daily volume for the next 5 days or so. But there is a market change in the holdings in gold and silver, and that's been over the news over the past few days. I'm pretty sure that a few front runners, even as well, people who are watching and having positions on the back of this index, have already been starting to manage their positions. We just have to be a little bit careful with what's going to happen in the next couple of days. And if you look at silver, markets wise, the percentage of daily volume, it can be a tad high. So this move down that we saw from yesterday down into 75 today, I think has a lot to do with some front running or already people starting to manage their position. Those who have books based on this kind of index, which is apparently there is quite a bit of money attached to this index. So if you see some of those moves developing in the next few days, just to not be surprised. Okay. Overall, as we've been showing already, once for as long as we are above that, and I'm happy that Stelios is looking at the same kind of levels. I already said, as for as long as we are medium term or above this box here, which starts at around 70.80 down to 69.30, as long as we are above, there's absolutely nothing bearish in the medium to longer term on silver. So we could see, because of the volatility, also those who look at pure text, if you start to break the 74.5, we could see a little bit more of a downside move in the next few sessions, maybe tomorrow, maybe on the data, maybe on SCOTUS. But once we get out of this window of rebalancing, and we would still be, which I think still be above this zone here, we could actually continue maybe to range trade for a while, jump up and down, as I've already said, but still very bullish in my opinion. Gold, sorry, gold is also looking on the corrective side. But here too, if you look at it for the more medium term, yeah, we should actually, for those who trade short term, look at what's happening if we get down to this 43.75, 43.80 perhaps. But for the more medium term, for as long as we are above this zone here, 42.45, 42.65-ish, where there's a convergence of lines, highs, lows here as well. This should really, for the medium term, still be very, very bullish indeed. So, but take into account what could happen on those indices. Okay. Couple I haven't looked at this morning because we were keeping a few goodies for F.A.C.E, of course. Aussie yesterday had this bit of a spike, also came back down, gave it up a little bit, just in line also with how the dollar is trading a little bit better. But every time, we see those inflation-induced spikes or drops in a currency, it is usually getting undone. And we're seeing again what was happening and that happened as well on the Aussie. We're coming into kind of interesting levels here for the short term, at least, and keep those in mind. If today is not the day that the dollar really moves or picks a real side, keep those in mind, those levels for tomorrow. And I would say especially that 66.60. Okay, if we get a test back of that 66.60 on the Aussie dollar, have a look at what's happening there. It's been showing up here as well, but it's been a very good springboard to do the last leg higher, sorry. And we are not too far from this little zone here. This zone starts at around 66.85-ish, but especially 66.60 going into tomorrow's data, I would say, are going to be relatively important. Kiwi is still the weak sister of the Antipodians. It just can't keep a beat. When you look at Aussie Kiwi, it says enough. We're still comfortably above 116 there. So this is also coming into a zone of potential a bit danger. And those equivalent lows at 66.60 on the Aussie are already showing up here in the Kiwi around 57.35. We are actually not too far away, only 15 pips away right now. But keep that level, monitor that level, because if it goes down below there, we could see a bit of a retest of lower levels, maybe dragging it down into the 56.80s before really reassessing what's going on. And one that has
data in about 15 seconds.
Yeah, okay. Let's look at those data then. Those are the initial jobless claims, especially Cable has started to show a bit of weakness. Sterling in general, actually, because as Ryan already said, euro sterling is moving higher. Here are the data.
208.
208
208,
better, slightly better. The last one revised to flat revision. Okay, 208. Nothing to
Nothing to see here.
dollars for, I guess. So here the cable, we're back below this little 134.57 zone. It started to show a bit of weakness. We also spoke about that yesterday in our chat room. People picking up a bit of euro sterling, selling a bit of cable. If the dollar, which I think is going to continue to behave relatively okay, we could see a bit of a retest of 134, 133.90 maybe, and then reassess if we get it into tomorrow's data. And with that, Ryan, back over to you, mate.
Thank you very much, mate. Yeah, that data not doing an awful lot. I'll just grab the screen back quickly just to run through the numbers that we've just had out. Yeah, those initial jobless claims, 208,000 coming in round about expected. We're still sticking at 200,000 mark. Continuing claims as well, up a little bit, but we've been in this 1.8, 1.9 million area for a while as well, so nothing to read home about that. We did get some unit labour costs, which were another negative. We expected to come in flat, but they came down 1.9% for the preliminary Q3 readings. A bit of Canadian trade data there as well. Not much to write home about in that lot. And a bit of trade balance data. Bit of an improvement there. This has been a bit of a wild swinger, though, given all the tariffs and everything else going on. But that trade balance coming in a deficit of 29.4 billion. So a bit of an improvement there. Not that the market's paying a blind bit of notice to any of it at all. Right, but as we wait for Blake to drop by, we've got an interview today with Peter Goodburn, so you'll be looking forward to that, I'm sure. Not a lot else out for the rest of the day in terms of data. Not too many Fed heads either, so we haven't got any input from that side of things coming into trading today. Kay, did you look at dollar CAD?
I forgot. Go ahead.
Terrible. No, that's all right. I was gonna have a quick look anyway.
Go ahead. I forgot.
People in the room having a conversation about it anyway. I had a little scalp long against this level. This is one of my big levels, 36, 60, 70. It's not looking too hot at the moment. I've got a stop pretty much just below the low of the day thus far. It looked like it was beginning to build and have a decent push up. This has been looking pretty strong ever since we hit the holiday lows, shall we call them, down here, 136.50, another big level down here. Nearly got up to the 50 retracement of the move that we got since November. This one is, if you're looking around and things like the euro and we're seeing lower volatility, there are some pairs out there that do have a bit more volatility. Aussie, as Kay mentioned, being one. Aussie Kiwi is a pair that's moving around a bit. Dollar CAD as well. We had yesterday, we had a move into 138. That failed. It came back to support around this 136.85, 37.85 area. Bounced from there, took us back into 138. So, yeah, if it holds around here, 50s, 60s, it has a chance of pushing back up. But if I start to see us failing against this level again, if I'm not stopped out, I'll probably fold in my long, and because that might mean we're going to get a bit of a pullback, maybe back down to the low 138s for that. Yeah, you're right, TT. It has been up. This this dollar CAD, it likes to trend. When it goes on a move, it goes on a move. We had, obviously going back a bit, we had when we, this move from all year, all the way down. Then it started to find a bottom. Then it moved up. Then it found another base. Then it moved up again. And so when it does like to move, it goes. So this could be yet another bit of a trend up, and maybe we'll get back up towards that 140 area, maybe even towards these highs again. So yeah, sometimes it's this is a good pair to trade when things are quiet elsewhere. Right, I see Mr. Blake in the house. Good morning, Blake. I'll go looking for Peter. See if he's
I am
about.
actually. I see Peter. He's in the attendee list, and I'm trying to promote him to panelist because we got a big group here today. So actually, one of the bigger shows that we've had in a while. So I'm glad to bring Peter on over. So Peter, if you see an upgrade notice to panelist, please accept so we can bring you on and over. There he is. Ryan K-Man, before we jump on with Peter, what's been going on? I mean, we just saw the claims come out a little worse than expected or a little better than expected?
No, well, it depends which calendar you're looking at. They came out round about expected. We're in that 200,000 area that we've been in for pretty much all last year. So nothing to write home about there. But one thing I just want to mention quickly, we were talking about this on the Flow show with the jobs data tomorrow. We had the ISM yesterday, which was a pretty positive number. Employment there went into expansion up to 52 from 49.8, I think. We're seeing obviously these jobless claims numbers being okay. We got an early leak of the Challenger layoffs as well in our morning. That was better than it was last month. There just might be a little hint that maybe the jobs numbers tomorrow could come out on the positive side. I think we're expecting some 60, 70,000. They might be a little better than that is the risk I'm thinking now, but it's a lottery at the best of times.
We can only hope so. I can only and look. I'm saying this from a positioning point of view, and I can't wait to actually look at Peter's work here in a few minutes regarding the dollar, what's happening in precious metals. So, Peter, I'm really excited to have you here today, and I'm actually excited to do the interview with you and be able to have this conversation with you. But I do want to mention just a couple of things. I hope the data is good from a trader point of view. I'm looking to be rather aggressively short the dollar. So if I can get the dollar perking up just a little bit further, get some U.S. exceptionalism type of story play in, get the euro closer to 116, because some of the Elliott wave work that I've seen is that the euro should see 116 and a quarter, and then rally above 120 eventually. So I'll take over the charts here, Ryan, and so I'm hoping that happens. There's another thing I wanted to mention really quick regarding data, and maybe K-Man might want to join in here in this conversation. These weekly unemployment claims. I was just talking to Maggie Lake over, most of you know who Maggie Lake is, and I was talking to her and Craig just moments ago about the unemployment claims. And Craig seems to believe that the reason why we're not seeing a big move from around on these unemployment claims is because of the gig economy, which reminded me that I do have a person that I've known for several years. He lost his job last year, and he didn't file for unemployment claims. He just became an Uber driver for a while before he found another job. He never filed for unemployment claims. So I think we're seeing a lot of that, because of the gig economy, people can be delivery drivers or whatever they want to be. What are your thoughts on that with unemployment claims, K-Man?
Yeah, plausible explanation.
Plausible.
But those jobs are always a bit insecure, right? I've also read articles about events, organizations employing a lot of people, but there are a lot of that is seasonal, right? And well, Uber maybe not. You can drive an Uber if the whole year around, but I don't know if those jobs are extremely secure. What I think about really jobs is the risk to the job market. One of the risks I see to the job market for 2026 is AI. They're going to destroy a lot of jobs. They are going to create some jobs, but they are going to be quite specific. But they're going to cost a lot of other jobs. So I'm not sure if all those people will end up in driving an Uber, but there may be a lot of traffic jams coming if that were to be the case over there. And we're also in, if you look at the official data, and we saw that yesterday as well, on the jolts, we're still very much in a no hire, no fire economy. So flatlining job numbers are likely typical of such a passage as well in the economy.
All right. Well, guys, thank you so much for your thoughts here. And I want to make sure that everybody listening to this show, you either go back and listen to the Flow Show in European hours, because that's how I, as a North American trader living in the United States, I get up to speed listening to K-Man and Ryan every day. Ryan hosts this wonderful show called the Flow Show. I just listen to the recording as I get up, because it's much better than cutting through all the crap that I have to listen to on CNBC. So I listen to these guys. They get me up to speed exactly how things have happened in Asia and in Europe. And then I'm totally prepared for the day. So make sure you guys are listening to their show in the morning. Ryan, K-Man, thank you so much for handling F.A.C.E this week, as I've been off running around with Ninja Trader this week, but I'll be on F.A.C.E next week for sure.
Thanks, mate. Have a good interview.
Cheers.
All right, thank you. And thank you, K-Man. So, Peter, we finally get to talk. How are you?
Yeah, great. Thanks very much, Blake. Yeah, pleased to be with you.
Yeah, it's nice to have you here. Sorry for the change. It was a last minute. We were kind of caught off guard on Sunday. So been handling all the interviews this week. But I've always, let me just say this, even though you and I have never really, I mean, we've spoke a little bit in kind of passing. I've always liked to listen to your shows and your interviews, because I find Elliott Wave work very fascinating to me, because it's not, you know, when there's like, your brain works a certain way, and like, you know, you meet people, they're like, you know, they're more mathematicians, or people are more, you know, literacy based, you know, that it's just working different parts of your brain. So from an Elliott Wave point of view, I always love to listen to what you have to say, because it incorporates so much of my Fibonacci work into analysis. Now, correct me if I'm wrong, you do like to take the charts so you can show your work, correct?
Well, yeah, sure. We can take a look at a few charts if you'd like to. Yeah, sure, we can do that.
I would absolutely love to, but can I start off by asking you just a couple of quick questions?
Mm-hmm.
We are at the all-time highs in the S&P. You know, people have perilously tried to call the top so many different times. From my Fibonacci work, we just hit 161% extension of basically the 2025 like January highs or early year highs to the lows after the Liberation Day sell-off, if you will. And we just hit, you know, the golden fib, 161% extension yesterday. And ironically, the market turned from that. Because we're at highs, because of our current environment, how do you feel about where markets currently sit? And and how do you feel about it, where we're currently at right now?
Mm-hmm. Yeah, well, I think overall, when you take a look at the movements up, people refer to the current uptrend as a secular bull market. And what they're generally doing is referring back to the financial crisis lows, or maybe slightly before, because don't forget that indices like the NASDAQ 100, they actually bottomed in 2002, towards the end of 2002, whereas, of course, the S&P and the Dow, they bottomed in March 2009. So you've got a bit of a difference going on. It turns out that the financial crisis sell-off into the lows in 2009 was actually a second wave pullback for things like the NASDAQ. But generally speaking, even if you're not aware of the history going back to the Great Depression lows, the financial crisis lows in those 2 date periods are where you should start your analysis from. So if you want to get a big perspective of where we are in the history of things, you know, that's where you have to go back to. And of course, we've got some fairly big corrections along the way. Of course, we had in 2011 a fairly big corrective downswing. It was probably one of the biggest ones that started following the recovery after the financial crisis. And then, of course, running right the way through, from an Elliott Wave perspective at least, the uptrend, the secular bull uptrend, counting up 5 waves from those financial crisis lows, you got a big third wave into 2018. And then we had a very satisfactory correction, which lasted a few years into the pandemic low. So you had a really nice fourth wave correction. And then from the pandemic low, we're engaged basically in a finalizing fifth wave. So generally speaking, if you take this all into context and forget about the news flows and everything, and just look at where the trends are coming from and where the measurable patterns are, we're in a concluding fifth wave from that pandemic low. And, you know, we've gone up quite a bit since that low.
Yeah.
So you might say that in the overall pattern sequence and the context of it all, that we're halfway through the fifth wave, which is a bit sombering, you know, when you think about it. But again, last year, you can see some of the big percentage gains in the Mag 7s and the FANGs indices and some of the individual equities. And you realize that even in this late stage of the secular bull uptrend, there's still huge percentage gains coming through. And, you know, and that's likely to continue for this year once the short-term correction's finished. So there's still plenty to trade from. But in the longer term context, we're halfway through the finalizing fifth wave, and that's a bit scary.
So Peter, I know you're not, well, I know you're not sharing your charts. Maybe you think you're sharing your charts, but I think you're available to share your charts if you'd like to.
I can, yeah.
If we are completing a wave 5, this could be a big deal. But the question is this it? And I think that's the question everybody's been asking, whether it's last year or this year. You know, when would you? And I could see it's just a blank screen at the moment.
Let me just stop sharing. I've got to switch to another screen. Stop share. Let's have a look. Let's have another try again.
Yeah, no problem.
Here we go. Let's try this one. Can you see anything now? Yeah.
Yes, sir, I can. All right, fantastic.
So this is a weekly chart of the S&P from the pandemic low at 2191, bottom left. So you can see now we're sort of like we're more than halfway through this. So this is the problem. This is a log scale chart, so all the measurements and the pattern itself is derived from log scale measurements. You've got to work in log scale at this point. It's no point trying to do this work in arithmetic scale or linear scale. But you can see that we're drawing a bit of a correction coming through this year to begin the year. And then after that, we start to move up to 78.50, which is going to be, if you can catch the correction low, then taking it up the next phase, that's going to be another big move. In fact, if we take a look at the equivalent Mag 7 pattern or the FANGs plus, that move up can be 50%. It won't be on the major indices like the S&P and NASDAQ, not that much, but on the FANGs and the Mag 7s, that would be equivalent to about 50% move. So if we can, as we suspect, get a bit of a correction coming in the first quarter, then that would be great to engineer then another long position and take the next run up higher. But this is a bit of a problem, when you take a look at the long-term stretch, because we're not generally, most people, individual traders, are not trading the long-term stretch. They might have a position for their 401k, for their pension or whatever, but generally speaking, if they're trading day to day, we've got to get inside this. The big problem will be later, much later, once we've topped this secular bull trend out, because then the whole paradigm shift occurs. That's when basically we implode. But we're not there for a long way yet, so we don't need to worry about it at the moment.
Yeah, I was gonna say, and this is for everybody listening, especially if you're watching at home. Some of you are in your car. You can't really see what Peter's charts say. Just so you guys can see, Peter's longer term views. I mean, you're looking out at when it's all said and done, maybe 9,500 roughly. But a correction from here could still take us down to 4,200. So you're talking into 2030, 2035. I mean, we're not, if you guys are just seeing this and it looks like a small chart on your phone and you're like, what exactly is it saying? This is really longer term stuff, Peter, right?
Yeah. Well, this is, I mean, of course. I mean, you're looking at foreign exchange and trading the news flows and looking at the next 50 pips or whatever. But yeah, this is something very dynamically different. But the question that you initiated really is where we are in the longer term trend. And
Yeah.
this is actually not the longer term trend. The secular bull market, of course, goes back even further. So let's have a look at that. And you'll see what the monthly chart on the S&P looks somewhat different. Here's going back to the financial crisis lows.
Yeah.
So this is the secular bull market from that magical 666 number, where we're going to up to the 90, 92, maybe 9,500 area. But you know, you're very late in the stage, so a lot of newcomers are trading, of course. Think that we're in a sort of a new paradigm that's going to last a bull market for probably their trading lifetimes. I mean, if you're in your 20s and 30s and you're trading, and you might see sort of 20 years ahead of you trading.
Absolutely.
And your bias is to the long side. No, that's going to be a pitfall. That's a problem.
You know, Peter, I've been at this game since the mid '90s. You know, when I first got my license in '95, and being over the age of 50 and almost to my mid 50s now, I really feel like I've seen a lot, but so many traders haven't. So many traders haven't been around for a big drawdown. They haven't, you know, tell us a little bit about your experience and about how nasty and how I think people underestimate how bearish bear markets can be.
Well, that's right. I mean, obviously we get to see in the stock market sort of these big dips. You know, here's the 2011 dip. Here's the correction. Don't forget that 2011 dip was minus 22%. From orthodox top to bottom in the fourth wave was 21%. So this is a sort of a Gann ideology where he says that corrections are similar percentages. You know, so this is part of Gann's work, which I'd studied many years ago as well, and picked up on these things, which help to differentiate the wave pattern and to condense it into a more integral and correct way of interpretation. So these little clues are really, really useful to do. But, you know, in terms of bear markets, you haven't really, you know, if you've undergone the last big bear market, which by definition was the dot-com bust, you know, that was a really big shakeout, because on the Dow, for example, from the dot-com peak in March 2000, you ran down into March 2009. So you had basically a 9-year bear market. And that's the definition of a real bear market. You've got 9 years, you know, going down, up into new highs and then down again. This was an expanding flat pattern. For those tuning in, you know a little bit about Elliott wave. But basically, the real concept of a bear market, we don't really, newcomers won't really be understanding exactly how severe those bear markets can be, because the stock market generally trends up. You get shakeouts, which are pretty quick, maybe a few months or more, and then it goes up again. And it's a bit like, you know, Warren Buffett. You know, if you're in this ideology that, you know, just buy the dips all the time, and if you've got a very long-term horizon and want to live to 95 like he's done, you know, you can, you know, you're in a bull market. But this next period is going to be very different. I actually started my career in the late 70s, trading in London on the commodity markets. By that, I was basically on the floor of the London Metal Exchange, and I was a market maker in the ring. And I was also market making silver, because in those last few years of the late 70s, we had the bunker hunt episode in silver, and I was trying my very best to market make on silver on occasions on the trading desk for our company. And that was amazing, because, you know, in the early to mid 70s, silver was $1.50, and then
That's
you know,
crazy.
Yeah, and you know, we could see that by the mid to late 70s, when I started my career, that it was already in a big bull market. But it sort of suddenly accelerated in those last few years up to $50. So you can see you know, just the sheer volume. But the thing is that the next 20 years was a bear market in precious metals. 20 years. We
Yeah.
went from 1980 down to a low in 1999, 2000. So that's a big bear market. So when you live through 20 years in your financial trading experience, and you see 20 years of bear markets in precious metals, what does that do to your psyche? Think of that.
Yeah.
And we've seen that also in base metals. You know, I was trading copper as part of the contracts. That was the main contract on the London Metal Exchange in those early 80s when I was trading it. And then you see bear markets also from sort of 80 to 90. You see 10-year bear markets, and then it goes up again, and then you get another big bear market. Or you see, you know, like, I mean, oil. I wasn't trading oil in the early 70s, but I certainly was tracking it from an analytical point of view, from an Elliott point of view, when we bottomed well, let's have a look at oil briefly on the long term. And this is a very long-term chart, by the way. We go back to 1930s, Great Depression, but I'm talking about this period here. I don't know whether everybody can see this.
Yeah, it's you're basically showing the 1980s through 2000s, and it's just huge range. I mean, you know, and when you see, okay, as you're illustrating all of this, Peter, this is where experience really matters for those of you that are at home. If you're a younger generation, you should really be taking notes right now, because what Peter's talking about as far as, you know, expanding flats, as far as the S&P goes, I mean, we could be in a drawdown for a very long period of time. And Peter, I don't want to step on what your analysis here is on oil. I just want to accentuate the fact about how important this all is, because when you get into sideways markets and rangy type of markets, whether it's a pullback or whether it's a range, it does provide a lot of opportunities for traders too, but you have to be in the right frame of mind as well. Is that correct?
Well, I think you do. I mean, I think the big problem with trading relatively short term is that you can, if you're not disciplined enough, you can make cumulative gains. You know, you can take 50 pips here and 100 pips there or whatever, and you're building your portfolio up nicely. And then just because you're not aware of the larger picture, when you take a trading position, if you haven't got automated stops in, and you're not disciplined enough with those stops, suddenly you get wiped out, and then suddenly you've probably done 50 to 100 good trades and seen a nice cumulative curve on your P&L, and then you give it all back in one or two trades, and this brings you back to zero again, and it's quite demoralizing. Actually, it's really bad news if you've experienced that, and I think a lot of people that's been in the business for a while would have experienced that. So the main thing to avoid that is to always you can trade the short term if that's your ken, but what you should be doing is also having a very thorough understanding of where you are in the larger picture. It's very, very important.
Yeah,
doesn't mean to say you have to trade that larger picture, but you must know where you are.
Exactly. And you know, Peter, I want to say something this is from a trader's point of view. Our job as traders is to trade the price action. But understanding where you're at in the longer term view, like I can forecast all I want, and I'm going to be right half the time, just as far as it goes for me. I mean, that's just part of analysis. But what's most important as a trader is identifying what levels are critical and how you trade around those levels. But where you are in the bigger picture also helps me personally with conviction. So if I'm let's just say looking at Peter's work, and I know that we're, turning lower longer term, I might have more conviction shorting from key levels because my bias might be more bearish based on some of the work that I've seen elsewhere. But as traders, and what Peter's saying, as traders, it's important to understand what the overall trajectory of the market is, so you can have conviction. You can put size or reduce size when you're trading around these key levels.
Yeah. Well, I mean, for example, when silver, we've seen this huge move up last year in silver. You buy the dips. It just keeps going, exploding higher, and we're getting an exponential rise. But at some point, you have to be aware where the pressure points are, when you break into new high. Now, a lot of people don't know how to measure a price development into new record highs like silver has been doing, because basically there's no historical background for it. So Elliott wave is a very good tool in this concept because obviously it's very deterministic. But that means it has a predictive quality to it, and you can take preceding waves and extend them on a log scale basis, and you can get to see where these new record highs and pressure points are coming. For example, we had a target long before we saw the over the end of the year silver trade up to $84. We had a target of about 81.50 months before that happened, months before. So we knew there was going to be a big pressure point, and the deviation of a couple of dollars above that pressure point was only about 30 minutes actually on the 28th of December, I think it was. So it basically was an exhaustion. Someone pressed a button, got a bit overexcited. So we saw a bit of an exaggeration for 30 minutes, and then it suddenly rejected that pressure point. This is very important. But the thing is that a fund manager, and an approach to the fund manager, is that he would say, well, okay, I'm gonna basically sit this one out. I'm not going to be buying any more into this late stage of a trend where it's gone an exponential rise. Even if the individual trader is making good money buying a dip and making maybe a couple of dollars on silver, which is immeasurable, especially if you're leveraging. You know, we can make a couple of dollars on silver. It's big stuff. But for a fund manager, he's recognizing the risk involved. And of course, after that December high that we saw basically $14 down the next day. $14. I mean, you get killed if you're using leverage.
Right.
So these things are very important, you know, because you can actually be a short-term trader, make consistent money. But for anybody listening in, yeah, please pay a little bit more attention to maybe the longer-term stuff, because you know, that's where you can eventually give back all of your hard work. And it's a bit demoralizing if that happens, but it only happens because you've taken your eye off the bigger picture and you've not recognized these points where the major trend reversals come in. I mean, this one that you're seeing on the graphic at the moment for the S&P, if we get up to 78.50, 7,900 max later this year, towards the year end, that's going to be a major pressure point. You know, if it deviates by 50 to 100 points, it doesn't matter. I won't be trading it long during that latter stage, because I know that at any point in time, the risk is too high. So you don't start trading the same leverage high into a move like that in the last phase of it, because you should be trading the leverage on the pullbacks.
Yeah. Yep, absolutely. And Peter, you know, I know we're kind of going into the top of the hour here, and I've had you here for quite some time. But I want to ask you this question because I think it's fascinating. You've been trading since the 70s, which is amazing. How long have you? And I've got two parts to this question. So the first part is, when did you start incorporating or learning about the Elliott wave principles and incorporating it into the markets?
Well, my job on the trading desk as a sort of like a blue button in the office in the late 70s was basically to get in before the market makers, rip off the teleprinter or the news, condense it into what was relevant, stick it on a piece of paper, and then photocopy it to 20 desks. And I used to read the news and see the news flows. And I used to think there's a complete disengagement between the news flow and what the price did. There was a complete disconnection. It was basically fairly arbitrary.
Has anything changed? Has anything actually changed?
Well, that's it. Yeah, exactly. You know, that's true, because you're right to point that out. It hasn't changed. And, you know, sometimes you get a piece of news and it does completely the opposite, you know, mainly. And then you begin to realize, well, what was happening there, you know, and then you start getting an idea about what positioning has been in the markets, how bullish or bearish sentiment might be, and whether or not that confers with the Elliott pattern. I got involved in Elliott wave about 1984. 1985, I was listening to, in London, there was London Broadcasting Corporation, which was LBC Radio, and they broadcast a guy who was doing a bit of Elliott Wave. He was a Canadian guy. And I thought, well, what is this stuff? And so I was tuning in, going up, commuting on the train with a little transistor radio with an earpiece, an earplug, and listening to this, you know, at sort of like 7:30 a.m. every morning. And that's how I sort of started to understand that markets can be irrational, and that there's an underlying format of where the market direction is developing to. And Elliott Wave made perfect sense. It sort of also dovetailed with my psyche about patterning and ratio relationships and the Fibonacci sequences, and what the derivative. Why is the Fibonacci sequence so adherent to the stock market, or the other way around, I should say? This whole science evolved. I began to see stock market forecasting as a science, and I started to understand some of the basic phenomena. So I've written various different papers in the past about that phenomena, and dug a bit deeper into the phenomenal origins of that. And a lot of people say that Elliott Wave is about psychology, but psychology also has an origin. And that was a real fascination point. So now we don't see financial markets developing in a random sort of way according to the news flows. In fact, we see the news flows following the price action.
Right.
The decision making already has a transpositional effect in the way it develops, and there are certain crossroads which appear. I know there's been a lot of criticism in Elliott Wave with some media outlets in the past, not so much recently, but probably going back 10 or 15, 20 years ago. But that was because they failed to understand that certain patterns in the Elliott Wave dictionary overlay more than one pattern at the same time. So you enter a crossroads, and for example, for those of you familiar with the dictum of patterns, a zigzag, for example, if you had a zigzag upswing, as we did start with the S&P actually from the pandemic low here, and you think, well, a zigzag is normally a correction pattern. It's composed of 3 price swings, and you can measure those into a proportionate ratio to help identify that. What's that doing in this pattern up into the January 22 high? Well, there can be several different ways in which that zigzag at that particular juncture could evolve into price action. So your job now is to actually develop what are the 2 or 3 possibilities in that, and draw them up, and then see where the price action is going to adhere to one and not the other 2. Once you fix that, you know the path for the next probably few years, or for the next few months or days, depending on the time frame. But so there are particular crossroads involved. And once you've got through that crossroad, once the path is set, it doesn't deviate very much. So then you've got a very, very good insight about what to expect. And that gives you a lot of confidence, because trading and making money in trading is about, as you mentioned the word conviction earlier. If you don't have conviction about what you're doing, you shouldn't trade at all. When you do have conviction, tempered with some equitable stops and processes like that, then that's really where you start to make money on a consistent basis. Because first of all, if you have an idea that the market's going up, but you don't have conviction, you can't really benefit from it.
That's correct.
And if you have too small position and you're right, and then the next one, you have a strong conviction and you're wrong, you're gonna basically go back into negative P&L. So you must have conviction about what you're doing, but it's got to be tempered with what you really see developing. You've got to have gateposts along the way where price action is confirming your ongoing hypothesis. If you don't have those gateposts being tick boxed, then step away and make sure that you're not exposing yourself. But if you're going through different gateposts and that means patterns, confirming price ratio development targets, and then reacting, and then after the reaction, resuming the trend. If you have these gateposts being tick boxed all the time, and you can then leverage, you see, and this is where you really start to make an impact on your P&L in a most positive way.
Yeah, and just to reiterate what Peter is saying, you know, as a trader, I make the majority of my money where I have conviction, and you know, but it comes from a combination of not only macro of how you feel, and that's where your conviction really comes from, but also the technical reasonings, you know, matched up with great risk reward that allow you to act on that conviction, and that's where the bulk of your money is made. Anyway, Peter, it's been a fascinating conversation. I really actually enjoyed this conversation. I'd love to have you back here on the F.A.C.E show. And let me, and I do want to point out, it's funny because you're like, well, I really started to incorporate Elliott wave back in 84, 85, and when I learned Fibonacci's, and I sat with my mentor at the time at his house for 2 weeks in 1996, and it was still at that point in time viewed more as witchcraft than anything. So it's so fascinating how Wall Street over the years, it's taken so long to embrace the technical views of the markets. Don't you find that fascinating over your time in the markets? It's taken so long.
Well, it's interesting to get your feedback on that score, because from my isolated point of I see that a lot of students coming out of university have been studying fundamental. They're being taught basically fundamental interpretation of financial markets. They're basically looking at spreadsheets all the time.
Yeah,
and it's a bit like that film Matrix, when Seifert is sort of like sitting in front of the matrix and all of the digits are falling down. And Neo says to him, well, what do you see? He says, well, I see blonde, brunette, redhead, you know. He sees the patterns in that falling matrix of digits, you know, and actually it's true. But, you know, here we are looking at bar charts or candlesticks, if you prefer, and we're making patterns form out of those. And that's what I see. Whenever I look at something like that on the screen, I see an immediate instant pattern. I recognize it most of the time instantly. And that's a very wonderful attribute if you have that eye to recognize patterns and the way that they do. I think everybody can learn it. It doesn't take long. There's a few little tweaks that you can do to help yourself. But, you know, the most important thing really with all of this is the way that universities at the moment are just teaching kids to look at spreadsheets and look and react on the numbers. And to me, it's a terrible travesty of our industry that's happened, because
algorithms are so
yeah, no one's going back to look at Gann's work or Elliott's original works or some of the other greats. I mean, some of them we can talk about that people aren't even aware of anymore.
I say bring back the Gann work, Peter. That's what I say.
Yeah, Gann's very, very tough. If you don't know astrology, I wouldn't go there. You've got to be a sort of an astrologer to understand Gann properly. Yeah,
I do agree with that.
That's a whole new gambit. Yeah.
So Peter, I'm gonna wrap us up here, but the best way for people to follow your work, I mean, we go to WaveTrack. You can go to wavetrack.com. You have a social media presence. How much are you posting there on Twitter and X these days?
Yeah, well, we're actually beefing up our social media a bit, so you'd be welcome to join us. If you go to wavetrack.com. And look to the right here, you'll see that we've just posted our latest stock indices annual 2026 video. It's almost 3 hours long, that video, and we've got a report that goes with it, which is I think if I've got it here, it's about it's 176 pages. It's a heavyweight. It's one of our longest annual reports that we've just published over New Year, and it's going through the whole stock indices outlooks from Europe, US, and the world. But in there is a roadmap for artificial intelligence this year. So do take a look at that. You can get details by clicking this button on our news alerts on wavetrack.com, and it will take you to this page, and it will show you how you can subscribe to that report. Now, that's a really good heavyweight. As I said, the video is almost 3 hours long, so you can take your time to view it. But we would recommend that. And in terms of social media, we're making a bit of a splash and a bit of an effort for everybody to subscribe to our YouTube channel. So just type in WaveTrack International in YouTube and you'll find us, and you can look at some very interesting videos. Here is an introduction to the latest video that we have for our stock indices annual report. And for those of you who'd like to subscribe to our bi-weekly reports, we push out 2 reports per week, which includes currencies and commodities as well as stock indices. Then just go to wavetrack.com and you'll see the Elliott Wave Compass report in the subscriptions here. And here it is. And you can see that it's a monthly subscription. There's no recurring subscription if you don't want to subscribe more than a month, but you can subscribe up to a year as well. And you can join us with that. And of course, Twitter, we have a good following there, which our handle is at @ElliotWave_WTI. So you can always follow us that way too.
Well, fantastic, Peter. And I'm trying to figure out what's the best way for me to reach back out to you in the following weeks to get you back on here.
Just the same way as you're doing at the moment. Just send me an email and we can connect. Yeah.
Actually, I don't have your email, but if you can, oh boy, I'll reach out to your social media.
Yeah. Well, I think our public email is services@wavetrack.com. And
Gotcha.
if you send something through there, I'll pick it up and then I'll send you my day-to-day email. Yeah.
Services@wavetrack.
Services@wavetrack.com. Yeah.
Okay, gotcha. All right,
Yeah.
Peter, I'll have you back on the F.A.C.E show. It's been a pleasure, and I'm really going to be interested to see what your views are after we got past the first couple of weeks and maybe even the next month or two in the markets, and see if your views have shifted at all. It's going to be really interesting. But thank you for spending your time with us. Thanks for spending your time with our F.A.C.E community. We do appreciate you, and I want to wish you the best of luck for the next couple of days as we try to navigate through this jobs report and the Supreme Court decision tomorrow.
Yes. Thanks, Blake. I really appreciate the invitation and great to speak to you today. Yeah.
Same here, sir. All right, traders. Hey, have a great day. Good luck. And remember, tomorrow's going to be an explosive day. Be back here on the F.A.C.E show for live analysis on the jobs report as we prepare for that Supreme Court, Supreme Court decision or opinion day that comes out at 10 a.m. Eastern. So have a great day in trading. I'll catch you tomorrow. Thank you once again, Peter, and good luck. All right. See you tomorrow.
Yep. All the